Robbie recently said, as someone who's retired, taxes have been a real eye-opener for me. It's like the hidden surprise that no one talks about. Well, Robbie, today we're talking about it. And we're going to give all of you 5 biggest retirement tax surprises. Hello. If we haven't met before, I'm Planner Mike, a certified financial planner, professional, and owner of True Wealth Financial. This is a show that's dedicated to helping Christians retire with confidence and clarity so they can finish their race with purpose. Thank you so much for tuning in. For some people, taxes can become one of the largest single item expenses in retirement. And the challenge with taxes in retirement is by the time you realize the impact of them, it's kind of too late to fix it. It's kind of like when you're driving down the highway and then you realize for whatever reason you missed your exit like 10 miles back. You can't just reverse and go backwards. I mean, you might be able to go down, take the next exit, but that just might add more hassle. And so you sit there and you're thinking you wish you would have paid more attention earlier, but now you're stuck taking the long way around. That's kind of where Bobby is. But if you're in your 50s or your 60s, you've still got time. So today I want to talk about the 5 biggest tax retirement surprises and how to avoid them. And of course, we'll give you a micro action at the end to help you get one step closer to your Christian retirement that is prosperous, enjoyable, and purposeful. Surprise number 1, tax withholdings for retirement are not automatic. Unlike when you're getting a paycheck, many retirement income sources don't automatically withhold taxes. Or if they do, they don't withhold enough. So the reason why this happens is because retirees a lot of times will forget to set up withholdings. On things like pensions, Social Security, and IRA distributions, it's not automatic. You have to actually set those up. And most retirees have never paid estimated payments, so they're not used to that kind of thing either. So the challenge is in retirement, you're going to have multiple sources of income. You're going to have some from Social Security. You might have some from pensions. You might have some from IRAs. And so what happens is those things stack up. And because enough's not coming out collectively through all those sources, you get a big tax bill. And unfortunately, a lot of times people get penalized for not withholding enough. So a couple ways to potentially avoid that. Number 1, you can use the Social Security form W4V to help withholdings from your Social Security. But you're going to have to actively set that up. You're going to have to work with your pension, if you have one, to get them to withhold taxes as well. Now, honestly, for my clients, I don't really like either one of those happening because if you just have Social Security, you won't have any tax bill more than likely. If you have Social Security and a pension, depending on your marriage or single and how much your pension is, you still might not have taxes that are due. So the best way to handle this, at least in my opinion, is one of the 2 ways. Either set up withholdings through your IRA distributions, right? So through proper tax planning, you can determine how much you need to withhold from your IRAs. And you can also send in estimated quarterly payments, sort of like self-employment people do. And between those 2 mechanisms, you can really dial in your tax withholdings and get to the point where you pay just enough taxes throughout the year, where you don't owe anything and you're not penalized. Surprise number 2, Medicare premiums go up with income. Many retirees don't realize, first of all, that they have to pay for Medicare. They kind of think it's free. You've been paying into it. You think so, but a portion of it's free, but not all of it's free. And what many retirees don't realize is that earning, quote unquote, too much money in retirement actually increases premiums by potentially thousands of dollars each year. It's called IRMA, IRMMA, which stands for Income Related Monthly Adjustment Amounts, meaning the more you make in a given year, the more you have to pay for essentially the same service. In some cases, IRMA thresholds start kind of low, about $103,000 for a single person, $206,000 for a married filing jointly couple, at least in 2025. And here's the thing. It happens because, again, you have multiple sources of income: Social Security, pension, IRA withdrawals, Roth conversions, capital gains, selling of property or business, and RMDs. All those sources of income can push you over those limits, not to account for the fact that you might have a single spike of income one year based upon some lump sum action that you take. And to make it even more confusing, there's a 2-year look back. So the 2026 Medicare payments will be based upon the income that you made not in 2025, but actually in 2024. So how can you potentially avoid it? Income control in key years, like the retirement years after retirement, but before RMDs, is a great time to help smooth some of that out. If you're doing Roth conversions, you can spread those out over multiple years to stay under those thresholds. And you certainly want to watch out for one-time income spikes like lump sum distributions from pensions, selling a business, selling a property, things like that. Retirement tax surprise number 3. Social Security benefits can be taxed. A lot of people believe that Social Security is tax-free. And that is true to a portion, but only 15% is actually guaranteed to be tax-free. Up to 85% of it can be taxed. And to make it a little bit confusing, it's based on how much of what's deemed as your total income. Bill that just got passed, technically not called this, but the One Big Beautiful Bill Act, that will help a little bit because starting in 2025, there's a 65 plus bonus deduction, right? So one of the campaign promises of President Trump was to make Social Security benefits tax-free. He wasn't able to deliver on that. And so this is kind of a compromise, giving people over 65 an additional deduction, which really can add up to be quite a lot of money, believe it or not. So again, why does this happen? The combined income, and we did a whole show on how Social Security income is taxed, if you want to go back and look at that. But your combined income is essentially your AGI, your adjusted gross income, plus your non-taxable interest, if you have like municipal bonds or treasury bonds, stuff like that, plus 1/2 of your Social Security benefits. Those sum together is called your combined income. And that drives what percentage of your benefits are taxable. So things like withdrawals from IRAs or 401ks can push up those taxable ranges. How to avoid it? A couple different ways. Number one, if possible, if your plan will allow it, you can delay Social Security. You can use those years then to potentially do Roth conversions and get down those later on RMDs that will push you through the brackets. And you can utilize tax-free accounts, things like Roth IRAs, HSAs, or even taxable accounts to help control taxable income. Tax surprise number 4. RMDs, or required minimum distributions, can push you into higher tax brackets. At the age of 73, at least starting now, it'll be 75 in the future, the IRS forces you to start pulling money out of retirement accounts. IRAs, traditional IRAs, 401ks, 403bs, SEP IRAs, accounts like that. Even if you don't need it, they're going to make you take the money out. And the problem is that RMDs count as ordinary income and they stack on top of your other sources. So they stack on top of your pension, stack on top of your Social Security, right? Stack on top of annuity distributions if you set those up. And those can trigger higher tax brackets. It can also trigger IRMA, like we talked about, and more of your Social Security is getting taxed. So again, the way to potentially avoid some of that is to get as much as you can into Roth accounts or taxable accounts as early as possible. You can do strategic Roth conversions in your early 60s to help reduce those RMDs later. And another thing we'll talk about in a future episode is you can potentially consider doing a qualified charitable distribution or a QCD starting at age 70 to offset those RMDs. Essentially, you take money from your IRA and you move it directly to a charity, right? And then you are never taxed on it and the charity gets that money tax-free as well. Surprise number 5. Taxes can get worse with the death of a spouse. Most couples assume that their expenses, to include their taxes, will drop when one spouse passes away. But in reality, the surviving spouse actually can face a higher tax bill, otherwise known as the widow's tax trap. So why does this happen? Upon the death of a spouse after that calendar year, the survivor will move into a single bracket. So in 2025, married couples basically get twice the brackets. They get twice the standard deduction. Well, after the death of a spouse, the survivor will move into a single. So the bracket's half. The standard deduction is cut nearly in 50%. And so all of that results in an acceleration of tax on the same income. You get through those brackets faster on an equal amount of income. Additionally, RMDs often stay the same or increase, right? So now RMDs essentially could transfer to the surviving spouse who still has to take those distributions. But now, again, that income is stacked through those smaller brackets even faster. And again, plus on top of that, you still have to take benefits potentially from pension or survivor Social Security benefits, and all of that can increase your adjusted gross income. So again, how to avoid it? We're going to sound like a broken record here, but get as much as you can into tax-free Roth or taxable accounts as possible prior to retirement. Use some strategic Roth conversions in your early 60s or maybe even earlier to reduce required minimum distributions. And again, you can consider a QCD starting at 7.5 to offset that. As we conclude, if you're still with me, please click the like button down there and consider subscribing. That will help spread the information to others who might need it. And more importantly, you'll be notified of future episodes. Today, we talked about the 5 biggest tax retirement surprises. Now, ideally, this should be done in consideration in conjunction with an overall comprehensive plan, one that considers your aspirations, your goals, your income needs, timing, and a whole lot more. But here's the thing. With proper planning, you can reduce your retirement tax bill. If you have any questions, please feel free to ask them in the comments below, or you can send an email to mike@truewealth.show. But for a micro action for today, might be to print off last year's tax return and highlight 2 numbers on it: your AGI, your adjusted gross income, and your taxable income. Getting some awareness of what you're paying in taxes is a first step to a strategy. And then you can determine, if you want, how much room you have left in that current bracket. Remember, as Christians, we want to be faithful stewards in every season, to include retirement. But taxes can quietly rob us of the resources that God has put into our trust, unless we plan wisely. Hopefully this helps you on your path to retirement that is prosperous, enjoyable, and purposeful. Till next time, hope you have a great day. God bless you.